You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Sean Brodrick, natural resource specialist at the Oxford Club. His website, InvestmentU.com. Welcome to the show, Sean.
Thanks for having me on.
Stock markets showing signs of recovery, but how real is that recovery?
Well, what it is it's a relaxation of the fear trade. I mean, the market was so worried for so long about so many things, right? And so a bunch of that fear has actually backed off, the latest being the Fed. The Fed put out its FOMC notes, and in it they say, we are aware of the market, so they are aware of economic conditions. So they're just letting the market know that maybe they won't be in such a hurry to actually raise rates. But there's a lot more to that. I mean, we saw crude oil jump 5% in one day, and on Friday, by the way, it jumped 12%, which was a huge jump. And so that's because people think, maybe there's an end game now between Russia and Saudi Arabia. We can speak about that a little more, and we probably should. Then we have the fact that a big part of the fear was people were really worried international banks were reaching some kind of crisis point, but there hasn't been any really follow-through on that, so people aren't so worried about the banks in Germany and China now. And so this and a bunch of other things happening, that because things aren't getting worse, people start to have hope in their hearts that things will start to really get, somewhat better, and that's how you see a nice 3-day rally like we've had.
Of course, I'm famous for asking the cops, when should we panic? Because they always say, there's no need for panic. Is there need for panic?
Well, one thing that I've been writing about on my blog is about earnings for the S&P 500, which are still not good. But that's another thing the market is looking at, is the earnings aren't getting worse the way they were. In fact, even though earnings will be down year over year, they're slightly improved from where they were just a couple years ago. This is the expectations of where earnings will be. So I'm not expecting a lot out of the market personally, simply because the earnings aren't there to support it. That doesn't mean we can't rally for a bit. The thing I would watch is what's happening with the central banks of the world, because the European Central Bank is making a lot of noise, dropping a lot of hints that in March it will start to crank up its quantitative easing program. We already know Japan has the printing presses wide open, and China is supporting its market as well. So keep an eye on that stuff, because they can float the market higher on a flood of paper money, right? Despite whatever fundamentals there are. And the worse the fundamentals are, the more paper money they're going to print. So I would keep an eye on the central banks into March. That could support things a while. But like I said, fundamentally, the earnings aren't there really to support much of a rally on their own. In fact, we are seeing still signs that the global economy is slowing down. The U.S. economy really seems to be doing fine, by the way, but the global economy seems to be slowing down. And so that's the thing about these big global U.S. corporations, right? Who are they going to sell to if things are slowing down in Europe, slowing down in China, stuff like that? That becomes a problem for them. So my personal expectation is not that good. I'd be happy to be surprised on the upside, but I expect things will be flattish to maybe downish. And, you can still play it, because this means you just do not buy the index. Instead, it becomes a stock picker's market. And so that's where it gets really interesting, and we get to have some fun.
Right. Now, what stocks would you look at? Biotechs?
No. And I don't mean to make fun of anyone who has biotech. God knows I've owned it before. But the money just whooshed out of there, right? And so it's probably not going to whoosh back in, though I have to say biotech stocks, or at least the good ones, are actually bouncing rather well right now. So there is something to that. They can certainly rally for a bit, but I might be looking at what's going on in the material space. I mean, we've had a nice rally in gold, which has come off a bit because people aren't so scared anymore. But I'm getting very interested in what's going on there. and in other miners which were really sold down to the basement. And so from a fundamental value, some of these look like they really have some room to rise higher. This still hasn't changed the situation in China, which doesn't need all the iron ore that the world's going to produce, and I still expect copper to be weak. But the prices these things were hammered down to just isn't justifiable. I'm also looking at energy. Much of that sector is still probably going to experience extreme pain going forward, but there's some other babies that were thrown out with the bathwater that really shouldn't have, so I think you can pick those up as well. Healthcare, I just got a nice buy signal on that. I'm not sure why. I'll have to investigate that some more. But remember, that was really hot for a while, and it cooled off for actually quite some time, months. So now maybe it's time for healthcare to start heading up higher again. Maybe people are starting to realize Bernie Sanders isn't going to win the election in the U.S., right? Because he's the one speaking about universal health care down here. So if he's not, maybe all the sell-off was overdone. I think there are some things you can look at. One thing to keep in mind is that there are stocks that do well when they don't have to pay much for energy, and despite the rally we've seen over the past few days, I don't expect oil prices to go too high, because there's about something like 4,000 wells that have been drilled but not completed in like Texas. And so as the price goes higher and it gets to the point where those wells can start to make money, they'll start coming on and start producing more oil. So it's a very fluid situation in the world's energy market. There are still some stocks that can make good money. Be careful in what you look at, but certainly there are opportunities out there.
With the Texas oil standing by, we were talking before we went on air about Russia and Saudi Arabia both saying, we're going to cap our oil production at January's levels. Well, January was a record month for both of them. So how much of a cap is that?
Well, that's the thing. They need other countries to really go along with them, because OPEC's producing flat out. I mean, there was a nice increase year over year in January, even though some OPEC members went down. Why did they go down? They had some problems of one sort or another. But the big trend is if you can produce it, you will. The ones to watch are Iraq, which has really, after Saudi Arabia, has really contributed the most to OPEC production, right? So we have to see if they keep a lid on things or if they're going to cheat on the new agreement they've just had, because you know what? They are able to punt more oil, and that's what they've been doing month after month, is increasing their output. So will they do that? Will they agree to stop? And Iran says it approves of the agreement between Saudi Arabia and Russia, but it's not going to feel compelled to go along with it. That's because they're just coming back to the market, with all sorts of production, after the sanctions on them were lifted, and they want to regain their global market share. So, I don't think things look bullish in the short to intermediate term. What we really need is we need for either global demand for energy to go higher, and or we need global production to go lower. And that's kind of a longer-term solution thing that we just aren't going to see in the short term. So I'm sure there are some people who have been using this rally in oil to add some short positions. I'm not one of them. But those people are probably looking for a turn back lower pretty soon, simply because this is kind of a relief rally and there isn't much substance to this actual agreement between Russia and Saudi Arabia.
Instead of just looking at crude oil, should people who are interested in petroleum look at the refiners or pipelines instead? Well,
here's a sad thing, and we have made money on refiners in the past, and I do like refining companies generally, but they're building a lot of refinery capacity in China. They're building a lot of refinery capacity in the Middle East. Just this past week, tankers with refined product on them, sent out of the Middle East, were turned away from Europe because there was simply no room in those particular storage tanks to take refined product. What does that tell you? That tells you that there's probably going to be downward pressure on refining margins, and so I might avoid those. On the other hand, if you have to pay a tanker to store your product and just drive it around in the Atlantic or the Pacific Ocean until you can find a buyer, that tends to fatten up the tanker profits. So that might be an area where you want to look.
We'll have more with Sean Brodrick right after the break.
Unbelievable harmony, spectacular performance, the ultimate tribute to the Everly Brothers and Simon and Garfunkel. Bird Dog and the Vintage Electric Band coming to Fort Langley, Mission, White Rock, West Vancouver. Buy online and save at ontourtickets.com.
Welcome back. We're speaking with Sean Brodrick. Sean, what about the word that most of the crude oil spaces for storage are just about full? What is that going to do to prices?
I've seen conflicting reports on that. I've seen the same ones you have from respectable sources, saying that there's only 11% of the storage left, and after that, that's it. That's in the U.S. Europe is in a worse situation. But I just saw another report. I believe it was from Societe Generale, though I'm not sure, saying, you know what? There's a heck of a lot more storage outside of Cushing now, because Cushing is what people generally measure, because that's where the oil is kept that's traded in places like New York and like that kind of thing. And they said there's a lot more storage outside than there used to be, so you shouldn't panic about that. It's an iffy situation. Certainly, it's something to keep your eye on. There is at least one publicly listed company that I can think of that actually stores oil. That might be one way to play it. But not that I'm doing that right now. So storage, I think, will continue to be a problem. And the reason is, even if they freeze output at the levels that we just talked about, we now know that the global producers are producing 1 to 2 to 1.7 million barrels per day more than the world uses, which means every single day you have to find storage for 1.2 million to 1.7 million barrels. And that stuff just keeps adding up and up and up. And so until that changes, we do have the potential for some kind of sharp sell-off in oil, simply because somebody needs to store something and they can't. Now, that doesn't mean it has to happen, but the potential is out there, and the potential is bigger than it usually is. So definitely keep your eye on that, and this is one of the downside risks in oil. This is why, these moves we've seen in, energy have been very good and certainly helping my positions, but at the same time, you want to be cautious about this because that might not work out in the short term.
What has this excess of oil done to the alternative energy market?
Well, solar got creamed for a while, though I'm starting to see them bounce back, I mean, it shouldn't compete with oil, but it's kind of a psychology thing and all that stuff. And so it hasn't helped natural gas, the fact that the price of oil is so cheap, right? I mean, now we have natural gas that's under $2. That's never a good sign. So, but I'm just thinking about alternatives to oil. And of course, coal's just been crushed, and that's just horrible. We could see some improvement in things like solar, because it looks like we're going to see more investment in that area. But that said, I mean, the solar indices, the ones that track the solar stocks, are near 52-week lows. They're about 10% off them. And that's not exactly good. If you're a bargain hunter, you can look at that kind of thing. But the trend for them is still downward. So I wouldn't get super excited about that, unless you're going to install them on your roof, because the prices are getting cheaper all the time. So there is that upside.
Gold. People think gold is just going to skyrocket. Will you see an immediate return, or are you going to need patience for it to play out?
Well, I think we need to be patient, because if you look at any of the longer-term charts, it has come up to serious overhead resistance, and it has to get through that. And so usually that's a process, right? It goes up, it comes back, goes up, comes back. It never gets through these things in one shot. And so I expect to see this go on for quite some time, but there are great fundamentals supporting the price of gold. If you go to energyandresourcesdigest.com, and that's AND, energyandresources digest.com, and look for my name. I've written 3 stories about gold and silver recently, since January, and just speaking about the improving fundamentals for these metals and these miners as well. Just to give you one, more money has flown into the exchange-traded products that hold gold this year, and remember, we're only in February, than all that flowed out of it last year. So a big clump of money has come back into it, rotated into it. So, that's kind of putting some ruffles back in the market. People are starting to think, maybe I need a little gold in my portfolio when I didn't have it before. Now, I have to say, I think the thing that'll be a real driver for gold would be more bad news out of the central banks in China and Europe and stuff like that. And I still think there's the potential for that. The kind of bad news parade has dropped off for those guys right now, but that doesn't mean that it's gone away. There are some serious problems for those banks. Maybe those central banks can work through them. Maybe they can't. But that's the kind of thing that really put a bid in gold in the months of January and early February, and I think could actually pump it up going forward. There are other things as well. I mean, some just a global supply-demand squeeze, for one thing, in gold, and so that's just the kind of thing that can really play out. So if you didn't buy gold the first time, and it went way up, and you said, dang it, I missed that train, you might get a chance to buy it again. I expect it to be volatile, but I expect it to back and fill before it really heads higher again, and that'll be a great opportunity for the more prudent investors because they'll have a chance to hop on board that train.
China, over the last 5 years, bought every scrap of physical gold they could, but has a lot of that cachet been spent trying to prop up their stock exchange?
Well, what they spent was U.S. dollars. That's the thing. And it's funny how the U.S. dollar barely blinked. I mean, when the Chinese spend $1 trillion, which is what they did, propping up their economy and their stock markets, and the U.S. dollar barely blinks, that makes you think, what's going on in that market, right? I mean, even though expectations for a rate hike by the Fed have really come off, the U.S. dollar isn't that far off its highs. It's still over 96. It's not that bad. It's pretty much in the same range that it's been trading in since last February. It's a huge, wide range where it goes up and down and up and down. So the U.S. dollar still looks strong, basically, when you get down to it. I expect the Chinese yuan, or the actual name is the renminbi. Calling it the yuan is like calling the U.S. currency the 100. But I expect their currency to continue to devalue simply because of market forces. People in China want to get their money out, probably before they get caught for stealing it, though that's not the only reason, and I don't mean to paint with too broad a brush, but that's at least part of the force driving it, right? So people want to get their money out, and we're seeing that general trend, and so right now we are seeing China's central bank spend U.S. dollars to defend its currency, but at some point or another they might say, you know what, if this thing was 20% lower, life would be a lot easier. And so then we could see a big correction there. So I would watch that. But of course, one of the big what-ifs for the market this year is something that no one actually talks about, which is the ongoing migration into Europe from the Middle East. It's huge. It's massive. They have something like thousands of people per day landing on the beaches in Greece. It's a huge gut punch to that economy, to an economy and a system that isn't set up to handle it. So you might think Europe is stable, but things could quickly spiral out of control there, and I would keep an eye on Europe as well. And if things do start to rock and roll over there, that could really send some ripples through the global financial system.
Sean, thanks a lot for chatting with us.
Always a pleasure. Thanks.
My guest has been Sean Brodrick, Natural Resource Specialist at the Oxford Club. His website, investmentu.com. You're listening to HowStreet.com radio. Find us on Twitter at TalkDigitalNet. Our popular YouTube channel is Talk Digital Network. Comments about the show or questions for Sean can be sent to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.